What if the money in your pocket was worth less tomorrow than it is today? An unsettling thought, isn't it? This is the reality of inflation, a phenomenon that subtly chips away at the value of your hard-earned dollars. Inflation is like a small leak in a boat. It's usually manageable, a normal part of any economy. Your dollar might buy a little less this year than it did the previous year, but it's generally a slow and steady process. But what happens when that leak widens and the boat begins to sink? That's when we enter the realm of hyperinflation. It's a frightening prospect, a rapid, often exponential increase in prices, where the value of money plummets and savings can be wiped out overnight. So yes, inflation is normal, but like anything, when it's out of control, it can wreak havoc. So how can we tell when inflation is about to go haywire? Stay tuned to find out. Inflation is a term used to describe the rate at which the general level of prices for goods and services in an economy rises over a period of time. When inflation occurs, each unit of currency buys fewer goods and services than it did before. In other words, inflation erodes the purchasing power of money. There are several key points to understand about inflation. Here are some causes of inflation that are influenced by various factors, including demand pull. Inflation is when demand for goods and services exceeds supply. Prices tend to rise as businesses increase prices to match the higher demand. Cost push inflation is when production costs, such as wages or raw materials, increase. Businesses may raise prices to maintain profit margins. Then there is monetary policy. Central banks can influence inflation through monetary policy, such as adjusting interest rates or controlling the money supply. Increasing the money supply can lead to inflation if demand for goods and services remains constant or increases. Now let's touch on the types of inflation. Inflation can be categorized into different types based on its cause, duration, and severity. Common types of inflation include mild or moderate inflation, gradual and moderate increases in the price level over time. This is the type of inflation that we here in the United States are experiencing currently. Then there is hyperinflation. Hyperinflation is an extremely rapid and out-of-control inflation, often characterized by prices doubling or tripling in a short period. Stagflation is when high inflation is occurring simultaneously with stagnant economic growth or high unemployment rates. What are the effects of inflation? Inflation can have various effects on individuals, businesses, and the economy as a whole, including reduced purchasing power. As prices rise, the purchasing power of money decreases, leading to a decrease in the standard of living for consumers. Another effect of inflation is uncertainty. High or unpredictable inflation can create uncertainty in the economy, making it difficult for businesses to plan for the future and allocate resources efficiently. Redistribution of income is another side effect. Inflation can redistribute income and wealth, benefiting borrowers who repay loans with less valuable currency and harming savers whose savings lose value over time. Inflation can influence interest rates as well, with central banks raising interest rates to combat high inflation and lowering interest rates to stimulate economic growth during periods of low inflation. How do we measure inflation? Inflation is typically measured using various price indices, such as the Consumer Price Index, CPI, or the Producer Price Index, PPI. These indices track changes in the prices of goods and services over time and provide insights into the overall rate of inflation in an economy. Overall, inflation is a complex economic phenomenon that can have significant implications for individuals, businesses, and policymakers. Understanding the causes and effects of inflation is essential for making informed decisions about personal finances, investment strategies, and economic policy. Now let's talk about hyperinflation. To understand the real dangers of hyperinflation, we need to look at real-life examples. Zimbabwe and Venezuela provide stark illustrations of the devastation wrought by runaway inflation. In Zimbabwe, the hyperinflation crisis of the late 2000s saw the nation's currency devalue at a terrifying rate. At its peak, prices were doubling every 24.7 hours. Imagine this. One day you could afford a loaf of bread, and the next, you needed a wheelbarrow full of cash to buy the same loaf. The government even issued a $100 trillion note, a testament to the worthlessness of the currency. The economic instability led to severe shortages of basic necessities, skyrocketing unemployment, and a mass exodus of people seeking better living conditions elsewhere. Venezuela's hyperinflation crisis, still ongoing as of 2024, has similarly resulted in an economic meltdown. The bolivar, once a robust currency, is now so devalued that Venezuelans often weigh rather than count their cash. The cost of everyday items has soared beyond the reach of many. A cup of coffee, for instance, went from costing 2 bolivars to more than 2 million in the span of a few years. The economic instability has led to a severe humanitarian crisis, with food and medicine shortages, rampant crime, and widespread poverty. These two cases highlight the harsh reality of hyperinflation. It's not just about numbers on a page or figures in a news report. It's about the erosion of the purchasing power of your money. It's about the struggle to afford basic necessities as prices spiral out of control. It's about the collapse of the economy and the severe hardships faced by citizens. Hyperinflation can turn a stable economy into a nightmare, but could it happen in America? You might be wondering, could the American economy fall victim to hyperinflation? Let's dive right in. The US government has a few tricks up its sleeve when it comes to controlling inflation. At the heart of these measures is the Federal Reserve, often referred to as the Fed. The Fed, with its monetary policy toolkit, plays a crucial role in maintaining economic stability. For example, it can adjust interest rates and control the money supply to keep inflation in check. One of the key tools the Fed uses is the federal funds rate, which influences interest rates throughout the economy. By raising this rate, the Fed can make borrowing money more expensive, thereby slowing economic activity, and in turn, inflation. On the other hand, lowering the rate can stimulate economic activity. Another key tool is open market operations, where the Fed buys and sells government securities, influencing the amount of money circulating in the economy. By selling securities, the Fed can pull money out of the economy, reducing the money supply and thus combating inflation. Buying securities has the opposite effect, injecting money into the economy and potentially fueling inflation. But here's the thing, even with these safeguards in place, there's been growing concern over rising inflation rates in recent years. The cost of living is going up and people are feeling the pinch. This isn't hyperinflation, not by a long shot, but it's enough to make people nervous. So could the US really experience hyperinflation? The truth is, while the chances are extremely low, they're not zero. A catastrophic event like a severe economic crisis or a sudden massive increase in the money supply could theoretically trigger hyperinflation. While the risk of hyperinflation is low, it's not impossible. So what would life be like in a hyperinflationary America? Let's explore that in our next scene. Imagine waking up to find that the cost of your breakfast has doubled overnight. This isn't just a bad dream, it's the harsh reality for those living with hyperinflation. In countries like Zimbabwe and Venezuela, that's exactly what happened. The value of money plummeted so rapidly, prices for everyday goods skyrocketed. Budgeting becomes a Herculean task. You might have enough to buy groceries today, but who knows about tomorrow? The cost of a loaf of bread could go from a few dollars to a small fortune in the blink of an eye. Social services crumble under the strain, as the cost of providing basic amenities spirals out of control. Schools, hospitals, public transport, all struggle to keep functioning. And the people bear the brunt of it, their lives turned upside down by the constant economic turmoil. Hyperinflation is more than just an economic term. It's a reality that could drastically change our way of life. So, what's the takeaway from all this? Well, we've journeyed through the concept of inflation, the potential nightmare of hyperinflation, and the impact they can have on an economy, particularly the American economy. Understanding inflation isn't just for economists or Wall Street moguls, it's for everyone. Why? Because it directly affects the value of your hard-earned money and consequently, your purchasing power. We've seen the devastating effects of hyperinflation in different corners of the world, and it's crucial to be aware that while it seems remote, it's not impossible. Staying informed about the state of the economy is not just prudent, it's essential. It allows us to prepare, to plan, and to protect our financial futures. While the threat of hyperinflation may seem distant, it's always wise to understand the possibilities. After all, the value of your money could depend on it. Please remember to like and subscribe